Hello, in this video we will be talking about dividend per share and dividend yield. How do you feel when you get an unexpected surprise from your parents or family? You feel happy, right? Similarly, dividend declared, these two words are a pleasure for an investor. And why not? It is an unexpected gain on an investment and also is tax-free. One of the best times for a shareholder in a company is when the company pays its cash dividend or stock dividend. For example, if a company pays a cash dividend of rupees 1 per share and a shareholder owns suppose 1000 shares. So eventually the dividend that is received by an investor is rupees 1000. But if a company pays a 10% stock dividend, then a shareholder who has 1000 shares will get an additional 100 shares. So that is what a stock dividend is. To understand dividend per share, we first need to understand what dividend is. So dividend is that part of the profit that the company shares with its shareholders. It means getting a part of the return on an investment made in the company. And this return is usually in the form of money. Dividends are important for shareholders as it forms the basis of additional income. A company's dividend is decided by its board of directors. Now, it is not at all obligatory for the company to pay off dividends. Some years it may pay dividend, on the other years it may decide not to pay the dividend. Now, there is no guarantee that it will continue or will pay in the same proportion. One of the best known companies, Berkshire Hathaway, owned by Warren Buffett, has in fact paid dividend only once in 50 years. Still, it has given great returns to its shareholders. Dividend can be either paid annually or quarterly. Now, you must be thinking of why do companies pay dividend at all? Well, paying dividends timely shows the positive financial health of the company. Companies having excess cash reserve generally pay dividends to attract their investors' interest in the stock. Usually, mature companies distribute high dividends while growing companies concentrate more on reinvesting purposes and therefore may pay less dividend or no dividend at all. The dividend per share, as the name suggests, is the total dividend divided by the outstanding shares. Calculating dividend per share is very easy. For example, a company, say company A, decides to declare a total dividend of rupees 4,000 crores in the financial year 2019 and the total number of outstanding shares is 1000. So dividend per share will be 4,000 divided by 1000, which will be equal to rupees 4 per share. The dividend per share is an important metric as it allows the investor to determine the amount of cash they will get on the basis of shares they hold. Dividends are a type of income for shareholders, especially for those who are looking for a steady source of income or are retiring. However, young investors who may not require the income can put those dividends by reinvesting them for portfolio growth. If you are looking for dividend income, then one of the financial metrics you should see is the dividend yield. What is dividend yield? Dividend yield is shown as a percentage term. It is calculated by dividing the annual dividend per share by the current market price. So for example, Hindustan Unilever's annual dividend per share was rupees 22 and say the current market price of that share is rupees 1818.05. So the dividend yield will come to 1.21%. A dividend yield tells you how much income you receive in relation to the share price. Buying shares on the basis of high dividend yield can provide a good source of income for risk-averse investors or those who are retiring. Thank you for watching the video.
Investment in the securities market are subject to market risks. Read all the related documents carefully before investing. Such representations are not indicative of future results.